It gives me great pleasure to bring on board Mr. Brij Bhushan Agarwal, Vice Chairman and Managing Director with Shyam Metalics. Mr. Agarwal, I want to start with a very basic question. Your company is not leveraged. You've done rather well in last 10 years, irrespective of the steel cycle. This is a boom of the steel cycle where I would imagine that cash flows are going to be superior. So why have you decided to go public? Do you need the money or you're going public for some other factors?
See, India is a very growing economy, and the company has been growing at double-digit EBITDA in last 15 years, in spite of so rough. So we have to be in the continuity of our journey, and after a certain stage of the growth, you need to be listed, you need talents, you need a better governance, and this is very important to grow bigger and to take more opportunity around through a listed entity.
Okay. Could you broadly walk us through what has been your USP? I mean, last 10 years, the steel industry has gone through a massive pain. Big companies have suffered, consolidation has happened. But if I look at the CAGR report, according to the DRHP, you managed to grow in double digit, both at EBITDA level and also at below the EBITDA, both at top line level and also at EBITDA level. What did you do which was so different that you managed to against the cycle and against the big boys?
See, first of all, for a metal company, cost is the major mantra. If you see the beauty of our 15 years history, if you see is cost. We are very, very strategically located on the bed of the raw material. We have been always have a good strategy on our growth. Whatever IRR model we have taken in the past, with our low cost of CAPEX, our good execution team, good talents in the organization, we had been able to achieve on an average 20 to 30% more cost effective, and a good working, a good product mix. If you see, we are serving to almost, whether we call it B2C, B2B institution, as well as in the international market. With so much of different product mix, we also have so much of different clientele, which is very, very important, which avoids all kind of stopple concerns in a growing organization with such a high revenue operations. So this is the major issue. And leverage, as you all know, that leverage is a very, very heavy cost. And in the past, we have seen a lot of companies have suffered on the leverage. So we have been always keeping ourselves very low leverage, very low debt. And this is going to be our precedence as our strategy in the time to come as well.
Okay, great. Good to know the kind of factors that play and the strategy with which you're moving forward. Let's talk about the fact that you don't have any captive mines, but you have FSAs, you have long-term linkages with OMCs as well as MOIL, Coal India. Have these helped you to avoid the recent surge in pricing? If we were to get into specifics, especially for iron ore, where pricing has actually doubled in the last 1 year.
Madam, if you see, all the auction mines which have been formulated in last 1 year have been very, very expensive. And it is over the market price, which is an IBM price. So we had been very fortunate that we were not the part of the auction. And the availability of the minerals across the mining sector from the secondary market, from the open miners are much more competitive. Our distinct advantage, I have already discussed, is more on the logistics side. We are on the bed of the raw material. We have a captive power plant. And when we are talking from the iron ore prospect, though we have a linkages with OMC and have a long-term linkages with the other miners as well, but we have a distinct advantage on the product side also. If there is any kind of changes in the iron ore cost pattern, the price of the finish also goes up. So this is basically a delta which the steel industry has been prevailing time to time.
Okay, and with these linkages and the captive power plant, how does your COP compare with your competitors? I mean, if we were to take a look at the commodity business, that's the one area where producers can have an edge.
See, if our last year, 15 years history is a very good example, how we have competed with the competitors, and the last 15 years has been a very, very rough phase. How we have grown double digit, how we have done an organic growth in the terms of EBITDA revenue. And in the time to come, I don't see a company like us with such a great fundamental values, with almost least leverage, so strategically located, so well diversified products in all segments. I don't see any kind of a risk in our business.
Mr. Agarwal, but just nonetheless, to just put it out there, who would you say are your biggest competitors across your product categories?
I feel, like we are in a very diversified product. So when we are talking from the Ferro Alloy prospect, there are companies like Mython who are in the Ferro Alloy business, but we have our own captive plant, which has a very distinct advantage. And where our cost is less than ₹2.50 per unit. Paisa, the standard grid cost is around 5 to 6 rupees a unit. So a ton of Ferro Alloy consumes almost 4,000 unit of power, which is a very distinct saving for the company. In the long product, there are other companies like Tata's and other companies are also there in the other markets. And in wire rods, where we deal in the engineering products, and so other big boys are also in the same sector. But we are a multi-diversified product. Like I don't remember like the kind of product where we are in, like any of the company, to my knowledge, is so much diversified. So in each and every product, different company is there. And this is all.
Sure. You have plans to double your capacities as well. What is the investment that you've lined up, and how is exactly are the capacities going to be commissioned? If you could give us timelines as well.
As per DRHP norms, we are not supposed to divulge any numbers on the value or the investment side, but I can very briefly state, like on an average, on the total CAPEX, every year we will be capitalizing around 20 to 25% every year, and the complete CAPEX cycle will be in the tune of around 4 to 5 years. And this is also the target from our CAGR growth prospect, what the company is emphasizing, a repeat of the heritage 15-year story of the growth of around 12 to 15% with the new CAPEX in the forms of revenue, in the form of capacity, and in the form of profitability.